In this video, I'll be talking about the cry for more stimulus and kind of the path put forward. I apologize for not having more videos recently. Finally finished my exam like 2 weeks ago and just been lazy and relaxing. These are the topics I'll be going over today. So when we take a look at the economy situation, so the poor are asking for more stimulus because they're struggling as to make ends meet. The rich are staying on the sidelines. So if you actually take a look at their spending since the pandemic has begun, they've actually cut their spending significantly, and they're keeping more cash or keeping and selling out of their equities, and they're buying into more real assets. The middle class, however, has been increasing spending and speculation. One thing you can see is the rising in real estate prices, also because of something I discussed before, where there's now a shift away from the big cities as people realize they don't have to live in the big cities in order to work in the big cities. But it's the fact that the middle class have no idea of what's going on. And this is also because of the lower interest rates. Then they realize, okay, something might be more expensive in a few years later, so by buying it now, they can get it cheaper. Next up, there's also increasing COVID cases, even though the death rate have been decreasing. But what happens is there's more potential closure fears. Some businesses will not survive another closure. Some have already permanently shut down. And finally, the V-shaped recovery illusion was over. In my opinion, it was like I never thought there would be a V-shaped recovery, even though there is some kind of a recovery in terms of the stock market, but that doesn't resemble the actual economy. But in my opinion, that was just a bubble that has finally popped. Now let's take a look at the market situation. For the bond market, there's no more price discovery because the Fed has just been there buying up amounts and they're pretty much targeting the treasury yields to a certain percent. And as you can see on the right here, the 10-year treasury has pretty much flatlined regardless of what's happening in the equities market or the US dollar. And this is something that is showing you the Fed's ability to manipulate the market by holding interest rate low and also buying up sufficient amount to keep the yields on a flat line. For equities, the crowded tech trade bubble might be popping. Maybe we can inflate another one back up. But as you can see, there's a big shift away from the tech stocks into more value and low beta stocks. And this is where the liquidity has dried up from the momentum chasing retail investors, and also the traders are getting out of it before while the retail investors are holding the bag. And finally, on the US dollar, so again, this US dollar is rallying as expected. I talked about this in my last video, but the thing is, I'm still bullish, bearish for the long term, bullish for the short term. And now let's take a look at the government debt concerns. Now, there's three aspects of government debt. There's the absolute amount, and just how much there is in absolute terms. And this is concern of everyday individuals because any government debt is to be repaid by individuals either through taxation or inflation. Liquidity, this is concerns of traders where short-term liquidity drives prices, where if there's a lot more liquidity out there, the traders are able to use that to generate day-to-day profit. And finally, the ability to repay. Now, this is the only one that's a concern of the government, as there's really no intention to repay, because if you take a look at the amount of debt that's growing and taxes is not rising to repay that, so there's no intention of repayment, but the only thing they care about is the ability to continue borrowing, which is interest costs, which is why you see the Federal Reserve's holding Treasury yields low by buying up the treasuries and expanding their balance sheet. Next up, let's talk about the Fed's struggles. So Powell mentioned many times that the Fed only has lending power and not spending power, and so they have been holding rate, and they're promising to hold rates at 0 for 3 years, 3.5, and of needing more inflation, and they're trying to push the responsibility or slash blame on Congress to spend more, saying like, hey, we got low interest rate because we're buying up the whole treasury market. They're effectively monetizing government debt. You should definitely just spend more, take advantage, because we're buying up all of them. And the reason why they're struggling is because the banks, so when they buy up treasuries, they free up liquidity in terms of reserves for the banks. So now the banks are able to lend more money out to the general, like everyday individuals or companies. But the problem is the banks are withholding that liquidity. Why? Because of risk. If you imagine, so let's say the bank now, they've already lent it to like their best customers, and now they're thinking of lending it to the less credit-worthy customers. But the yields that they're getting from it is not worthy. So let's say maybe they can get like a 1% from this customer they could lend to, but they're risking losing maybe 20 or 30% of the principal value of the loan. So cost spent, and with inflation being higher, meaning real yields right now is negative because the expected inflation rate is higher than all of the treasury yields. They're not making any money, so they rather take a little bit of loss in terms of negative real yields than losing like a bigger portion of the principal value of the loan. So the Fed's dilemma is they don't want to make the market too hot, because then it would just they want to be able to prolong this process and just keep it range bound instead of it getting too hot too soon and then just imploding completely. But they are also not willing to let the market go down. So they're printing enough just to keep it range bound. They got up to 7 trillion in terms of their balance sheet from March to May. They slowed down until recently, and they haven't been back up to 7 trillion for the past 3 weeks. So now let's talk about the Congress conflicts. So the bill, like everyone's asking for another stimulus bill. My opinion, the bill will be passed. It's just a matter of when. Democrats they originally asked for 3.5 trillion. Now they're thinking of going down to 2.4. Republicans agreed up to 1 trillion. And the thing is, everyone agrees that more stimulus is needed, just how much. And this is nobody wants to deny free money in an election year. But in my opinion, this does nothing. In terms of real economic growth, it delays the pain, but it makes the ultimate pain so much worse. Now let's talk about the US dollar. As mentioned from previous video, I expected the US dollar to rally. As we can see from the US dollar index, now back above 94 from the low of 91. And it's rallying from the lack of liquidity because the Fed has actually slowed down balance sheet expansion from May to just recently 3 weeks, and that's where you see liquidity drying up, and that's also why the stock market's having struggles, and it's putting pressure on the commodities as the US dollar continued to rally. And I'm expecting it to rally to maybe 97, 98 for US dollar index. But in terms of long-term wise, it will continue its decline. So let's talk about the commodities implication. So right now, in general, commodities are waiting for the next round of inflation, or like an indication of inflation, or like more indications, because a lot of people has already priced in, and some just are not confident or believing into what the Fed has already done in terms of money printing and what they're going to do going forward. Now, the Fed has already restarted balance sheet expansion. Like I mentioned, they're back above 7 trillion. They did 30 billion in this prior week and 50 billion the week before. These are big numbers, and they're similar to when QE3 was going on. In the precious metals, on top of waiting for indication of inflation or more of it, the COMEX manipulation. So JP Morgan was recently fined for $1 billion for manipulation in precious metal market and also the treasuries. And the reason why they're probably just taking the fine, because they probably did a cost and benefit analysis for how much money they're making for doing the manipulation and how much they have to pay the fine. And I think they realize they can make a lot more money, and because the market is so small, they're able to make a big price fluctuation. And what I think they're doing is because usually the big banks were the shorters, and they're realizing the game is over, and so they're trying to push the price low by driving all the stops, because when traders buy these contracts, they set a stop loss. So if they just drive the price down very quickly, they can run the stops, and once it gets to a low enough position, then they can just buy it back up and make that profit. And this is, I'm also thinking, because it's a contract month for September is ending next Tuesday, and that's why they're trying to get out before upcoming big open interest month like December with over 400,000 contracts. Next up, for agriculture goods, I think we're just waiting for more agriculture like Department of Agriculture reports, and as the cold weather continues. Finally, energy, I think it might be a good time to pick up high quality, good balance sheet companies, definitely not the more speculative one. So something that we're waiting for is, as the factors like that are still bearish, like US dollar index, as that continue to rally, if you see commodities prices stop falling but maybe rising along with the US dollar index, that might be an indication of a good buying opportunity. Finally, let's take a look at the future outlook. So pandemic is not improving as cases continue to rise, and I don't know if we're going to go through another full shutdown. I don't think those in government would like to see that in terms of the cost for the general economy. So I think they're just going to let it go. Wall Street gain at the cost of Main Street pain, because what happens is all these stimulus, they're being funneled into the big corporation. That's why you see like these massive PE ratio, like for example, like Amazon, Apple, or Tesla. Tesla, that one's funny. When that one implodes, well, I mean, it has been blown up, so that one's just kind of funny. But the thing is, it takes resources from Main Street, and that's like when you allocate resources away from a sector, that's why you see Main Street suffering more, especially when inflation starts kicking in, like more. And now for the Fed to not let the market crash, it's holding interest rate at zero for like 3 years. That's its promise. There's more money printing to buy up financial assets to keep prices from falling. by buying up the debt that nobody wants. They can keep yields low and also keep these companies continue surviving. The government's commitment to promise more free money means more deficit, and more deficit means more money printing by the Fed, because when there's more um, fiscal stimulus, they have to issue treasuries to pay for them. And who's buying up these treasuries and keeping the treasury yields low? It's the Fed. And that means any fiscal policy right now is more monetary policy. And because there's not enough tax revenue to pay for it on the fiscal side. So that's why the Fed comes in and just buys it up. They don't actually buy it from like right off. From the government, what happens is the big banks buy it, but then they immediately sell it to the Fed on the secondary market and make a little profit. And in terms of endgame speculation, like this is like maybe a year or two out, but in my opinion, this is inevitable, where they'll let inflation run hot, but eventually it'll become out of hand. Like they can't control it. They let the genie out of the bottle. And at first they'll blame the corporation for rising prices. So they'll enact possibly price controls. And that's when supply shortage will occur, possibly a food shortage. And finally, the only way to stop inflation from getting out of hand or continue to get worse is they have to cut the tap, no more money printing, and let interest rate rise. That's something we've already seen in the 1970s with Paul Volcker. And by doing so, I think they'll cause the Greater Depression, where we're in so much worse shape in terms of debt, and all these companies who will not be able to afford any interest rate spikes, they will have to go bankrupt. And that means more job losses. But that's the longer we try to prolong this pain, the worse it will be going forward. And there's no other way out. And I think, eventually we'll just have to bite the bullet, but it's just how bad is it going to be?